Just, if I could ask just three things. If you have a question or a comment, raise your hand, one. Two, tell us who you are and where you're from or who you represent. And three, who the question or comment is for. Your thing, not just REITs, but your background is more in alternatives. Mm-hmm. The way that a lot of markets have been going up almost at the same time together, the correlation has been kind of disturbing for some people. Mm-hmm. Does that make a stronger case for alternatives, for non-correlated returns?
In the long term, alternative investments are definitely less correlated with broad financial market indices. There is huge amounts of empirical evidence to support that. But during times of crisis, such as say in 2008, 2009, when risks are driven by systemic factors, it is those times that correlations converge, and lots of people say that, hey, alternative investments haven't served us well. But over the medium to long term, alternative investments are a pretty good idea. Also, alternatives are a pretty heterogeneous class. If you're speaking about, say, private equity, which these guys do, we're talking about venture capital, special situations, mezzanine, distressed investing. If you're talking about real estate, what we do, we're talking about core, value add, opportunistic funds, non-traded REITs. Then there's this whole spectrum of hedge funds, equity, long, short, relative value, global macro. Then there are real assets. So we can see it is such a heterogeneous class, each with very different asset sub-characteristics. So I guess specificity and choice in alternative investments is extremely important.
Is it fair to say that the higher your net worth, the more you should be looking at alternatives, or the more alternatives should form as a percentage of your portfolio?
That makes a lot of sense. In fact, if you look at endowments, you look at the institutional investors, you look at the ultra high net worth segment, their allocations go up to as much as 30, 40, 50%. And the reason for that is they are able to, for example, unlock the illiquidity premia. If you are not seeking to defease very short-term asset liabilities, you can unlock that illiquidity premia. Moreover, there are many other opportunities, such as in, say, niche credit investing that are otherwise not available in the more liquid markets or so. So there is decidedly a big case for alternative investments for the mass affluent, very certainly now, and especially so for the high net worth.
Is that true for PE as well?
In terms of
yield, right? And when I think about, Samir, what you do, REITs and real estate, rising rates and REITs don't always go together.
Yes and no. The relationship between interest rates and real estate valuation is tenuous at best. It really depends on the trajectory and pace of interest rate changes. If interest rates increase in response to an improving economy, inflation, replacement costs going up, that is probably good for real estate. But if interest rates go up because of, say, mis-signaling as they went up last year in May, that is bad for real estate.
So here's the thing. If you take the glass half full approach or view, then it's good for real estate. What view do you take? What's your fundamental view right now? On the state of the recovery in the U.S. economy and in real estate too.
I think that the U.S. is in a mid-cycle expansion phase with activity rebounding. So we have a much steadier outlook this year than what we did last year. There's less ambiguity. There's more financial stability. There's less fiscal drag. And there's cyclical momentum and a general improvement in most leading indicators. And I think you'll see that reflected in the volatility of the stock market too. The VIX has been in the 10, 15, 20 range. Yeah. And I think that's because we are still able to acquire properties at high cap rates. That itself is very attractive and a good entry point at this point in time. Value-added real estate, I think, is going to do well. And within hedge funds, long-short strategies, but with a long bias, I think that's a pretty good area to be in at this point in time. For our investors, and we have around 2 million retail investors who are looking for yield, something like oil and gas, something like hospitality, where hotels reprice in an improving economy. That's going to do well. Something that can be very core to portfolios, like, for example, grocery-anchored retail. I think that's something.
Grocery-anchored retail. Oh.
Everyone has to go to a grocery
sure,
shop.
of course, yeah.
So something like that is going to do well. Abilities to arbitrage misvaluation between public and private markets, that's a good strategy for this and the next year. So it's a wide gamut of things.
So you talked about this before, public and private, where REITs are concerned. You think there is a role and a place in portfolios, especially as your net worth goes up, for private REITs, is that right?
Oh, huge, huge. And the reason for that is people are looking for periodic stable cash flows. They're looking for low volatility. They're looking for low correlation. They're looking for something that has some level of asset value growth potential, something that can be actively managed.
Why would they be better than, say, a REIT you could buy on the market?
A REIT that you can buy in the market, you would be exposed to vicissitudes of capital flows, stock market behavior. It has very little often with the intrinsic value of the real estate that you own. Also, if you're investing in public markets, you're forced to put out that money to work right away. If you're a private investor, you seek most opportune entry points in the market. You're able to hold out market cycles and exit when it is once again most opportune to do so. So there are lots and lots of very good reasons why you should invest in real estate, especially, as well as real assets in a private, illiquid format.
Okay, so publicly traded REITs, I'm curious because, for the folks out in the audience who are Asians or who are based in Asia, there's REITs are extremely popular here. I think in this reach for yield, they've done extremely well over the last year or so. But in the U.S., right? Next year, as rates go up, where is the opportunity? Is it in residential, commercial, industrial? Where?
I'm not too sure about multifamily. I think that is pretty much bid up. Residential too, I'm not too sure. But areas like exactly what you said, storage, industrial, distribution, hospitality, these niches, I think, are where at least we as responsible stewards of investor capital.
Really? Okay, we're kind of shy. This is unusual. I've been told that, Milken conferences are not usually like this. I'm not sure what's going on here. Okay, Samir, let's spend a little bit more time with you and alternatives. Next year, what is going to make you money? I guess you got to talk about not just obviously the manager, but also the strategy.
I think the biggest opportunity is in creating proxies for fixed income, because investing passively in traditional fixed income now exposes investors to low expected returns. It has little scope for capital appreciation. There's very little scope for unlocking an illiquidity premia. There are lots and lots of very interesting credit niches that you pass on. So something like, just because you call something fixed income, it doesn't really mean it is fixed. So I think the biggest opportunity for us is to redefine fixed income in terms of what fixed income was supposed to be. Durable income, something that has its edifice, its foundation in multiple drivers of return, not just interest rates, but certainly interest rates too, but credit spreads, illiquidity premia, alternative risk premia. And the idea being, the more the drivers of return, the more the resiliency of that investing thesis, and the lesser the dependence on one particular market factor, such as interest rates. So things like real assets are a great place to be in at this point in time.
Bricks and mortar is what you're saying.
Bricks and mortgage, but things like infrastructure, oil and gas, real estate, perhaps even timber, agriculture. These are pretty good areas now to be in.
I think that's a good point. We actually have a subsidiary, Wood Creek, that focuses on that.
Here is going to be what?
It's going to be our ability to look 3 to 5 years into the future, to live in 2017, 2018. And this can be a skew of factors. But given the higher contracting costs, the longer term nature of our assets, et cetera, it's going to be our ability to not miss the forest for the trees.
Yeah, because you guys have much longer cycles, right?
Exactly.